You want to know, what are the best stocks to buy now? And how do you buy in a hot market like this? Now, there is a proven strategy that you can leverage in any type of market conditions, and I'll explain later. The focus today is on growth ETFs for long-term investors. I'm going to share with you my top 7 growth ETFs and how I'd leverage these to make money in the stock market. One of these ETFs, I'd be willing to bet that you've never heard of before. In fact, if Fired Up Wealth were to start an ETF, it might look really similar to this one. Here are the top 7 growth ETFs that I would buy. All right, first, let's look at core ETFs. Now, usually when you think of core ETFs, you're talking about maybe QQQ, the VOO, that's the S&P 500, and maybe something like SCHD. But SCHD is focused on dividends. Remember, this video is focused on growth. So the first thing we're gonna do is we're gonna look at QQQ versus the VOO. So the QQQ is the NASDAQ 100. The VOO, of course, is the S&P 500. Now, the VOO does have a much lower expense ratio at 0.03 versus 0.2% for the QQQ. And when you see AUM, this is assets under management. You can see they're both very large, $250 billion and $414 billion. Now, these are very different indexes, of course. The QQQ has 102 holdings. You can see up here. The VOO has 505. Now, if you look at the top holdings, both are going to have heavy concentration in those mega cap tech stocks. But the VOO is going to have much more diversification. It's going to include more sectors, and really it's a balance between 50% growth and maybe 50% value. Just to give you a quick idea, 84 holdings overlap between the VOO and the QQQ. 16% of VOO's 510 holdings are also in QQQ, and 84% of QQQ's 100 holdings is in VOO. Now, we're going to look at performance for each of these ETFs, but remember, of course, that past performance does not guarantee future results. Over the last year, the Qs are up about 49%, and over the past 5 years, over 150%. The VOO is up 27% in the past year, and over 5 years, about 80%. So of course, QQQ is going to be the clear winner if you're focused on growth, but I want to show you something quick. The QQQ has been around since May 7th of 1999. Now, in October of 2020, Invesco created another ETF called QQQM. Now, these are essentially the exact same ETF. They're both the NASDAQ 100. The difference is the expense ratio is about 25% less on the QQQM. Now, I've been investing for years, so I own QQQ, but if I were a new investor and if I were long-term investing, I would use QQQM. Assets under management, you can see that the Qs have 250 billion versus 22.1 billion. The main difference here is an expense ratio, and on the Qs, you're going to use that. It's going to be more liquid. You're going to use it for more trading if you're day trading. If you're long-term investing, you can go ahead and use the QQQM. So when we look at core index ETFs, there's one clear winner, the QQQM. All right, so next let's look at some core ETFs that are a bit more diversified, but still focused solely on growth. Now we're gonna do a side-by-side comparison of 2 ETFs, and these are gonna be large cap growth across multiple segments and sectors. And sure, the QQQ has some diversification outside of tech. It really does. If you look under the hood, it owns things like Costco and Pepsi, but the reality is it's heavily weighted in tech, and specifically mega cap tech. Now these next 2 ETFs could be good replacements for something like the S&P 500, where you want to have diversification, maybe a little bit more outside of technology. And this is assuming you have a longer time horizon and more risk appetite. Both of these next 2 ETFs absolutely destroy the S&P 500 or the VOO. And really, that's what we refer to when we say beat the market. We're talking about the S&P 500. In fact, the winner from this next category beat the S&P 500 by 50%, over 50% in the last 5 years. In 5 years, the VOO gave you around 80%. The winner from this category, over 130%. And the loser from this next category still destroyed the market by 40% in the same time frame. So this next category is core large cap growth. And we're comparing the SCHG and the VONG. Of course, Schwab and Vanguard. Now, both of these have low expense ratios, but the SCHG is 0.04% versus 0.08%. And both of these are massive in terms of assets under management, 25.9 billion and 18.8 $9.8 billion. And both of these do pay a dividend. You can see VONG has 0.65%. This is annual dividend yield, and the SCHD 0.42%. And you can see on your screen, these are very different in terms of the structure. 443 holdings on the right versus 249 holdings on the left. And both of these do have heavy concentration in those top two stocks, Microsoft and Apple. You can see both of them are around 12 and 11%, slightly different. NVIDIA is also the third holding, but about 2% larger in SCHG. And really, if you look at it, the top 8 positions on both are the same, just with different weight. But as you dig into these ETFs, they are quite different because you're going to see names like Snowflake, even though it's a smaller position, things like that. So if you dig into these, they are different, but they're both focused on large cap growth. So 181 of these holdings overlap, and 76.4% of SCHG out of the 250 holdings are also in VONG. And then 42% of VONG or VONG out of its 450 holdings are also in SCHG. And you can see the sector drifts down here. So tech, you're going to have a little bit more weight in tech on SCHG, and that's why you're going to see some of those names like Snowflake. So SCHG is going to be a little bit more aggressive growth, and if you look at the performance over 5 years, it really proves that. Over the past 5 years, SCHG at the time I made this video up about 132%. VONG about 122%. So both very solid, but SCHG does beat over 5 years by about 11%. So the winner from this category is going to be SCHG. All right, next I want to share 2 core ETFs that are focused on tech. Now, the last category we know destroyed the S&P 500. But just for reference, the QQQ did beat SCHG by about 20% over 5 years. So QQQ is still going to be the winner between those 2 categories. Now, this next category that's focused on tech annihilates everything we've talked about so far. Both of these are information technology focused. FTEC and VG. So you have Fidelity and Vanguard. Expense ratios are decent for both, but FTEC is 0.08% versus 0.10%. And you can see that VGT, of course, Vanguard is much larger when you look at the AUM. 64.2 billion versus 9.12 billion. These ETFs are very similar. You can see 300 holdings versus 314, but if you look at what's under the hood, they're very similar. Now, one thing I want to point out about both of these ETFs, look at the concentration of Microsoft and Apple for both. You're talking about 40% or more concentration in those 2 stocks. Now, these would be decent ETFs if you didn't own these individual stocks and you wanted to build up some ownership, some concentration in these positions. If you already own Microsoft and Apple and it's 5% of your portfolio, these ETFs might not be the best fit for you. And to be clear, all of the ETFs we've really talked about to this point are going to have concentration in mega cap tech, but these are significantly higher. Just to show you what I mean, guys, QQQ is on the left now, 102 holdings versus VGT, 314 holdings. Microsoft's 8.74% in QQQ and almost 21% in VGT. Apple, same kind of deal, 8.13 and 20.22%. So which is the winner between VGT and FTEC? To be honest with you guys, they're about the same thing. FTEC does outperform by about 1.5% over 5 years. The fact that it has slightly outperformed with a lower expense ratio, FTEC is the winner. In Fired Up Wealth, we talk about secular growth trends and trying to ride those mega trends to capitalize profits in our portfolios. So we talk about artificial intelligence and cybersecurity, electric vehicles, 5G, metaverse, Internet of Things, and more. So next I'm going to share 6 thematic ETFs, and I'll pick my favorites from the list. Now these puppies are cooking with gas. This is the SOXX, up 247% over the past 5 years. And SMH up 303% over the same period. But which is the better semiconductor ETF to buy now? Well, it depends. Let's break it down. Okay, so the expense ratio, exactly the same, 0.35%. One's going to be VanEck, one's going to be iShares. Assets under management, both are huge, 15.6 billion and 12.1 billion. SOXX does pay a higher dividend, 0.7% versus 0.5% for SMH. 26 holdings for SMH, 31 for SOXX. The primary difference difference here, there are really two. NVIDIA is going to be 26% weight on SMH versus 10.77%. And SOXX on the right here, going to have some smaller cap names, like you can see Axcelis and Wolfspeed. And those are smaller positions, but that's really the two primary differences between these indexes. And the reason SMH has outperformed SOXX, of course, NVIDIA, higher concentration. And one primary difference between the two here to point out, Taiwan Semiconductor is 9.45% of SMH and 3.84% of SOXX. So which is the better semiconductor ETF to own? Well, over 5 years, you've got 250% on the SOXX and SMH at 300%. So if you look at just performance, and again, past performance doesn't guarantee future results, SMH is the winner. Now, with that said, it's going to depend on what you own in your portfolio. For me, NVIDIA is my top holding, and it's 11% of my primary taxable brokerage, my $1.9 million brokerage account. So if I'm buying an ETF, I'm probably going to buy the one that has a little bit less exposure to NVIDIA because I already own a bunch of NVIDIA. That's house shares. If you're just starting out or if you don't own NVIDIA, well, it might make more sense to buy SMH if you're trying to own some NVIDIA. What's another secular trend that we can capture? We know that semiconductors are the new oil. We just covered those. What about cybersecurity? So here are two solid picks for you to explore. WCBR has a 0.45% expense ratio. This is the cousin of WCLD, so Wisdom Tree. And then First Trust has this ETF called CIBR, and the expense ratio is 0.59%, so it is a little bit higher. Assets under management, you can see a big difference there. $6.64 billion on the left side, only $103 million on the right side. Now, WCBR is a fairly new ETF, but this would be one risk to consider, because if an ETF does liquidate, you still get the money for your shares, but if, say, there's not enough funds to keep the AUM going to fund the project or the ETF, they can essentially close that ETF down and just give you the money for your shares. 33 holdings versus 26 holdings. There are a lot of similarities to these, but I do like the holdings better in WCBR. You can see CrowdStrike is the top holding, 7.39%. It's also 7.11% in CIBR, but Broadcom is going to be the top holding there at 7.42%. And again, I already own Broadcom and I've owned it for years. And so I might look at this and decide which ETF to buy based on the individual stocks that I own in my portfolio. Like I said, overall, these are very similar, but the weights are different. A few different names that you might notice in here as well, like HCP. Now, this is a good free tool to use, guys. You can see the website up here in the top left. I'm not sponsored to tell you that or anything, but it is good. And you can see the overlap here between the two cybersecurity ETFs we're talking about today. One of the big differences, Broadcom, this is a blend of semiconductors and software, but I would really classify it more on the semi side. And this has 7.4% versus 0. So that's going to be a difference. Elastic, you can see negative 0.6%. So this gives you a good snapshot of what's in what. I like the holdings better on the right-hand side, but this is a much more established ETF on the left side. WCBR hasn't been around long enough to do a 5-year comparison. It's only been around since January of 2021, but you can see in the last year, it is up 53.5%. In the First Trust Cybersecurity ETF, it's up about 38% over the past year. So WCBR does outperform over the 1-year period. And of course, that has to do with the holdings under the hood. So you have to look at each of these ETFs and see how they might fit into your existing blueprint and portfolio. Now, I've got more ETFs to cover, but if you're trying to outperform the market, you're focused on growth, you're trying to outperform the market and get to where you want to be in life. If you want help with that research and information to help you with your decisions, you're in the right place. And I ask you to please subscribe, click that bell for notifications. And if you're already subscribed and this video is helpful, do me a favor, drop me a comment. Do you like these ETFs? What ETFs are you buying in your portfolio? What's another secular trend we talk about? For me, if you look at my portfolio, it's very heavy in semiconductors and what? Cloud, SaaS, software as a service. Now, you might be surprised at my next pick, so you're going to want to see it. So we're looking at the same two companies here, First Trust and Wisdom Tree. So we looked at WCBR. Now we're going to look at WCLD, and then CIBR for First Trust. Now we're going to look at SKYY. Expense ratio, WCLD is lower, 0.45% versus 0.6. Assets under management, Sky's been around longer, 3.05 billion. WCLD, only 727 million, but much more than its cousin that only has 100 million. So 65 holdings and 68 holdings. You can see right at the top here. Now these are going to be very different ETFs because WCLD is going for more equal weight and Sky is not. The other key difference here is that SKY is going to focus really on more mature companies overall. WCLD is going to have the smaller caps and maybe more speculative names, the ones that aren't profitable, burning cash. So if you look over here, you're going to see like IBM, for example. You'll never see that in WCLD. Oracle, you're not going to see it over here. And you really just need to dig into these and look at what's under the hood. You know, there are very different in terms of concentrations and the different stocks. There's a lot of overlap as well too. So let's take a look at that. So there's about a 60% overlap that you can see right here. 38 holdings overlap. And here are your key differences right here. Again, you're going to see Alphabet and Microsoft and IBM and Oracle, Cisco. You're going to see that in SKY, and you're not going to see it in WCLD. So which ETF would I pick for cloud? Now, again, this is going to be depending on your portfolio. I own a lot of these individual stocks, and I don't necessarily need to have overlap and more concentration. Now, this is where you might get surprised. WCLD hasn't been around quite 5 years. It started in September of 2019. It's only up 40% since that time. In the past year, it's only up 25.57%. Now, SKYY has been around since July of 2011, and it's up 355% all time. In 5 years, 62.45%. And over the past year, 48%. So what's going on here? Well, of course, the larger cap names have been popular. Those have been in fashion. People are buying profitable companies, and the speculative names really haven't caught up. Now, that is part of a bottoming process coming out of a bear market, and WCLD could play catch up later. But based on my individual stocks and what I own, I might actually go for SKY because it has some of the names I don't own. Now, with that said, I like the names better in WCLD, and for most portfolios, that's probably your huckleberry. I'm going to cover one more ETF, and this is the ETF that you need to see. If I were creating an ETF, if Fired Up Wealth were creating an ETF and using the community to buy the top stocks to ride secular trends, this next ETF would be pretty close to what we might build. Now, before I do that, I promise to explain to you how you can buy in a tough market. The way that you do that is you're going to periodically dollar cost average. So every single paycheck, let's just say you get $250 of extra cash left over each paycheck every 2 weeks, you invest that in the market, $500 a month. And it might be more, it might be less. I started with $50 a month, 20 plus years ago. And as I made more, I saved more, and I invested more. The only way that this approach will work, though, is you have to buy consistently all the time. If you're trying to time the market and then save cash and wait for a pullback, it's a lot harder. If you've got time on your side, if you're young, or even if you're not young, but you've got at least, say 10 years, 10, 20 years, but 10 years is kind of the mark. If you invest every single paycheck, if things are going to be worth more in 10 years, you're buying all the time. You're buying the highs, you're buying the lows, you're just buying, and you don't worry about it. You're not stressing about trying to time it all the time. You're just buying every single paycheck. It's really easy. You don't have to think. Don't overthink it. Don't make it overcomplicated. That's how I would buy ETFs. And then I would buy individual stocks around the ETFs. I would periodically buy into your favorite ETFs every single paycheck, consistently, every single time. If I'm accumulating wealth, that's exactly what I'd be doing. Now, if you're not at that stage, maybe you're already retired or you're in that wealth preservation stage, well, that's a different approach. But if you've got some time on your side and you're wondering, how do I buy in this type of market? Periodic dollar cost averaging is your answer. This next ETF has not been around for very long, but over the past year, it's absolutely smashed it. To give you some perspective of what we've covered so far, the QQQM is up about 49% over the past year. The second two we covered, 49% and 47%. The semiconductor ETFs, of course, 57% plus. Cybersecurity, 52%. Cloud, 47%. So the range really is 47 to 60% over the past year. And again, past performance does not guarantee future results, but this next ETF, 73.3% over the past year. Any guess of which ETF I'm talking about? So we want to ride secular growth trends. And guess what? This ETF is doing that as well. They're talking about digital transformation here, automation, robotics, artificial intelligence, space exploration, green energy. Hey, this looks pretty good. SPIR Alpha ETF, ticker SPRX. What does this ETF own? So the issuer here, SPIR Advisors LLC, and I just have it compared to WCBR, which is of course WisdomTree, just to look at assets under management, because we talked about WCBR, it's 103 million. This one is a newer ETF. It has 71.3 million. The expense ratio is 0.75%. But if you're getting a 73% return, well, the expense ratio isn't really that big of a deal. So SPRX has 29 holdings. NVDA is going to be about 12% concentration. This would be a great ETF if you're wondering, hey, I want to buy some NVIDIA. I want to own it, but I'm not sure if I want to buy the individual stock. And I just want to periodically dollar cost average because I like all these companies. Instead of buying all the individual stocks, I can buy this ETF. So Zscaler, 10.23%. You can go down the line here and everything you see on the left-hand side of your screen, I own every single stock except for 3. Now, the ones I don't own, HubSpot, GitLab, and RIVN. And I wouldn't mind actually owning any of those stocks, especially the software related names. And RIVN, I think if you look at which US company for the EV market can be successful other than Tesla, Rivian's probably the answer. Of course it relies heavily on Amazon. We can go down a rabbit hole, but I like all the names on this list, especially if you're owning them as a small concentration in an ETF. You're talking about Rivian being 3%, 3.14%. But look at these names: NVIDIA, Zscaler, AMD, Snowflake, SentinelOne, Confluent, CrowdStrike, Marvel Technology. These are fired up wealth favorites. It's almost like we made the portfolio or the ETF. You get the idea. The second page gets interesting, and there are some names in here that I don't know a lot about, but these are pretty small positions. You can see 0.07%, 0.27%. Now, recently, I just did a video recently on this one, NVT, and that's about 1% of this ETF. And you can see it's got, ALB and some mining type companies. So trying to capture the pick and shovel and the secular trend of electric vehicles and so on. There you have it, the best growth ETFs to buy. If this video is helpful, drop me a like and comment. I appreciate your time and attention. Have a great rest of your day. Take care.